there was definitely some kind of justification for AI-related stocks to do well at some point. But as with all bubbles, it's really hard to know whether how far that's still justified or whether we've gone so far beyond the justification. Our suspicion is that we're now deeply into bubble territory. And again, when we talk about stocks doing well, as you were just saying, you've got the S&P 494, and then you've got the six that did incredibly well last year and ended up producing 2/3 of the S&P gains between them. So it's if we look, there's a lot of worrying signs. If we look more broadly at across asset markets, if we look at economic factors, there's a lot of really worrying signs out there. But there's still a lot of liquidity still flowing around, and there's this massive fear of missing out. So people are still jumping on the magnificent 6 or 7.
Paul, if we look at the earnings season, I mentioned it being lacklustre, but there have been some standouts, and something we've been debating since the start of the show, the cutbacks you've seen in the tech sector actually yielding results at laser-like focus and profitability and trying to sort of turn around the psychology for a lot of those tech investors. Are we seeing some of them? I mean, Uber was the latest that recorded its first annual profit, and that stock has been one that's been bouncing with the rest of the market. Are there some stars out there, which is why we are seeing some appetite again for investors to get back in, even at these levels?
No, look, clearly we are, but again, it's whether the reaction to that is proportionate or not, and we suspect it's not. Again, going back to this story about 494 versus 6, if you look at the earnings growth, the year-on-year earnings growth, then as of last week we were looking at plus 50% year-on-year for the 6, and minus about 10.5% for the other 494, or at least those that are reported. So clearly, this is the worst case of bad breath in the market since 2007, apparently. The question is, are those 6 justified? Are there any other cases that are justified? And what about the rest of the market? And our worry is that as I say, the 6 have just got out of control. It's all about fear of missing out. It's all irrational. It's all bubbly. Look, bubbles can keep getting bigger and bigger for a long time before they burst. So we're not saying that they're going to burst tomorrow. But if you look at earnings season, the most interesting thing for us was the bank reporting. And, the banks are having a pretty rough time of it. And the reason why that's so important is obviously banks are one of the conduits of credit impulse into the economy. Bank lending, seems to be falling off a cliff very suddenly. It had a real spurt in November, December, pre-Christmas, and now it seems to be falling off a cliff. Well, the numbers before that were bad. We then had this spike, and now we're going back to bad again. That suggests there's no real source of funding going into the economy if US government doesn't carry on, spraying money around like a drunken sailor on shore leave, which is what it was doing for the last 6 months of last year. But there doesn't seem to be any way that it can continue doing that for this year. The continuing resolutions don't seem to allow that. So we look like we're heading into a very different scenario in 2024 than the last 6 months of 2023. And therefore, we've got to take with a pinch of salt any earnings that look good.